next session, we will talk about the case for sustainable finance. Obviously, up until now, we have discussed the asset owner's role, and then the asset manager's role, the role of the policymakers, and we will now have Bertie Whitehead, Goldman Sachs Head of Energy, EMEA ECM, and Evan Tylenda, Executive Director of the European Goldman Sachs Sustain Team, to share their views about sustainable finance. The environment is, the landscape is really moving more and more. We are seeing efforts, joint efforts to boost sustainable investments. Without further ado, I will pass it on to you, Bertie and Evan, and thank you very much for your participation in our event. The floor is now yours.
Well, I shall start. My name is Evan Tylenda. I lead the European Sustain research team here out of Europe, but Sustain is actually a global team within Southside Research. We have a head in the US as well as a head in Hong Kong as well, covering clients globally. I'm going to share my screen right now. I'll start off kind of providing a high-level view of what we're seeing from, key stakeholders in the investment value chain. I'll talk about the growth that we're seeing related to ESG AUM. I'll then dive a bit into the data, and then also highlight, our own proprietary scoring framework that we have to measuring companies on their ESG performance, as well as talk about some of the regulation that is coming out here in Europe that I think is quite relevant. But one thing that I think is helpful to understand this whole debate is that it's not just one stakeholder that is really driving ESG to be integrated into capital markets. It's really coming from all key stakeholders, that being society, where employees are caring much more about what their companies that they are working for in terms of what they're doing related to ESG and sustainability. You have, regular retail investors wanting to invest sustainably and putting pressure on investors to start incorporating ESG into the investment process. You then have governments also putting pressure on corporates to start disclosing this information to investors in the capital markets, and then governments are also putting pressure on investors to factor in this data when available. Really, you then have investors and corporates in between, where investors are just looking for better information. It is our belief that ESG information can provide insight into hard-to-measure areas of operational excellence, culture, and risk of a business. And so, therefore, there is information and insight in getting access to that data and engaging with corporates around rising trends that are going to be financially relevant, not only today but in the future. And then corporates are trying to differentiate, not just to society, to their employees, to their consumers, but really to investors, because there is now a benefit to doing so. We are seeing premiums expand for corporates that are fitting into ESG funds. I'll talk a little bit about that later. And so we just see this natural virtuous cycle happening that is leading to ESG becoming integrated more and more. I think a helpful slide that talks about the spectrum of what is sustainability investing. It is important to recognize that it's not just one thing. There's a lot of terms thrown out there: ESG, SRI, impact. First and foremost, we need to recognize that ESG is multiple things. There's different things that investors are trying to solve for. But we do find increasingly that there is a narrowing definition of what folks are trying to focus on. And those three categories that you see here are: you have your ethical SRI focused investor, who really is driving their investment decisions based on values and morals. It's really exclusionary in nature. It's based on looking at companies that, say, have human rights violations, avoiding alcohol, tobacco, sin stocks. Increasingly, we're seeing exclusions being set for companies that maybe have 5, 10, 20, 15% of their revenue driven from fossil fuels. That's a big area of focus. It's really, SRI is really the first, traditional way to incorporate sustainability views. That is evolving into kind of what we would call, the 2.0 version of sustainability investing, which is ESG. And ESG is where we focus most of our time and effort. And it's really just looking at non-financial information to better inform the investment outcomes. And so, it is our belief that there is alpha and there's insight in ESG data. Now, we can talk about how different investors are applying that non-financial information. Oftentimes, what you'll find is that they're taking an off-the-shelf solution from MSCI, Sustainalytics. There's a lot of third-party raters out there. There's also now an expectation that if you're integrating ESG, you're engaging with companies. So this is perhaps why this is so topical today, is corporates are getting questions that they weren't traditionally getting, a year, 2 or 3 years ago. And largely because a lot of the data that investors are looking to make their decisions off of just simply does not exist yet today. So that engagement component is really important. And then the third category you have is impact investing, where the investor is not just trying to drive a financial return, but also some form of positive environmental and social impact, largely via the products and services that a company produces. So this is where you get a lot of your thematic funds, clean energy funds, renewables, low carbon, diversity, financial inclusion, education funds, and so forth. Now, this is the smallest component of the AUM, but is one of the fastest growing segments. And what we are actually finding is that, while there are these 3 distinct strategies, when you look across the thousands of ESG funds out there and look at the underlying holdings, it's fairly clear to us that this is actually becoming the narrowing definition of what just makes a good ESG company, is looking at this checklist. If you think about a company that's going to get included into an ESG fund, it's going to be one that is not controversial, tends to score well on ESG ratings, or is demonstrating that they're genuinely factoring in material ESG risks and recognizing opportunities with their communication to investors. And then if they do have some product or service that is leading to a positive environmental social outcome, that's a really easy company to include in an ESG fund today. And so what that is doing, it is leading to this kind of narrowing, scarcity value for a lot of companies that, we are finding that companies that fit into this are trading at significant premiums relative to peers. But why is this important? Because the growth in the AUM is accelerating off an already large base. Some of you have seen some of these numbers before. The way that we characterize the global market for incorporating ESG is looking at the PRI signatories. The Principles for Responsibility Investment Initiative has been around since 2006. And you can see the growth here in the bar chart and the line chart representing the AUM, where as of the beginning of this year, we have over $100 trillion in AUM behind PRI signatories, and we have over 3,000 asset manager and asset owner signatories, which are up significantly from just last year alone. Last year, we had 2,500 signatories. So these numbers are accelerating. So really, we are finding that all of our largest institutional clients are PRI signatories. Now, candidly, being a PRI signatory had not meant much. It really was just a pledge of the allegiance to say that you are going to incorporate ESG into your investment process. You're going to engage with companies and be active owners. You're going to seek appropriate disclosure. You were going to promote the PRI. But what PRI did at the end of 2017 was came out with 3 minimum requirements that now signatories have to also meet in order to maintain their status as a signatory or run the risk of being removed publicly, which we actually just saw last month. 5 signatories were removed after an engagement period of 2 years, so they can no longer claim their signatory. But the biggest criteria now that the signatories have to abide by is they have to demonstrate that they're integrating ESG into at least 50% of their AUM. So if you look at, there's $100 trillion behind PRI signatories, 50% of that now must demonstrate that they're integrating ESG. That suggests that $50 trillion today needs to become aware of ESG factors. So that's quickly branching out beyond just equities into all asset classes, as well as reaching into not just developed markets, but emerging markets as well. And we see this only continuing. Now, certainly most of the growth has come from Europe. The US is, though, catching up quite quickly, and we're also seeing this around the rest of the world as well in Asia. Just quickly on fund flows, we've seen massive fund flows into ESG funds, which have been consistently positive. outflows out of non-ESG funds have been consistently negative. So this is becoming something that a lot of clients are having to just participate in to maintain their asset base. And what this is going to do for corporates is put additional pressure on the information that is reported to investors. So if you look at a lot of the reporting frameworks out there, GRI, the Global Reporting Initiative, is the most widely followed. It's been around for 2 decades. It's quite flexible in its approach in the way that it allows companies to report through. That's increasingly being seen as not good enough for the investment community, because oftentimes that data is not comparable, it's not consistent. And so what we are seeing is a growth in these investor-focused reporting standards like TCFD, SASB. I formerly worked at SASB for 2 years, so very familiar with some of these approaches. And those are continuing to grow in importance, as we just need better data available from the investment community to really analyze a lot of these trends and how companies are performing. I'll skip past this slide. This is just showing again the growth in AUM, the number of funds being launched. You know, the ESG ETF space is picking up quite rapidly. This, I think, is an interesting one. This is showing the premiums for companies that fit into ESG funds. So when we looked at over 3,000 ESG funds and looked at the 50 most commonly held, most overweight, and most relative overweight companies in those funds, we are seeing them trading at growing premiums versus their sector peers, as there's just scarcity value really when it comes to ESG. They're also outperforming the market during the drawdown. I mean, no surprise that, you know, a lot of the sectors that are most overweight include a lot of thematics that are coming through, like water utilities, independent power and renewable energy, building products. While if you look at the exclusionary side, which sectors are most underweight, it tends to be tobacco, aerospace and defense, oil and gas, electric utilities, a lot of heavier sectors, mining, metals and mining. And then lastly, I'll quickly highlight, you know, just the regulation is growing rapidly. It's doubled since 2015. Most of that is coming from Europe again, but we're seeing it pick up around the rest of the world as well. I get to quickly some of the data work that we've done. We've assessed all of the ESG data in its purest form, looking at data as reported by companies, such as many of yourselves, to see what is available and usable. We've seen that there's been a massive growth in ESG data available to investors. However, it is extremely messy. We know it's not often comparable, it's not timely, it's not consistently reported. So those are all challenges that we've dealt with. However, if you look at the ESG information the right way, we do tell our institutional investment clients that there is alpha to be made. We know that companies are starting to report actually very similar things, particularly if you look at Europe. So disclosure alone is becoming less differentiated, while there are still large disclosure gaps while looking at different regions. So what this is showing is looking at the top 50 most disclosed metrics. What is the top quintile average disclosure rate broken down by region, and then what is the bottom quintile? And you can see where that band is narrow is suggesting that, you know, all companies are starting to report very similar information. But again, that does depend on which region we're looking into. So there is a challenge of actually, depending on how you're analyzing this information, based on the outcomes that you will get, and I'll show that on this slide. And what we found is, you know, with the information that is available, 70% of the data that we get from corporates is unfortunately very vague and binary in nature. It's a policy statement that the company has, a community relations policy, a human health and safety policy, a resource reduction policy, things actually that investors, I don't think, find too helpful, because it's not always quite clear how ESG goes in, or how these policies go into practice. Now, what we are increasingly finding is that the numeric data is increasing, and that's the good thing. So we now have 25% of the data that is numeric. So these are hard numbers around water usage, energy usage, carbon footprints, injury rates, diversity rates, and so forth. That's up from 14%. And then targets round out the remaining 5%. And what we did is we actually back tested this information. So when we look at companies that actually have a policy versus their peers that do not have a policy, we find that they tend to underperform on their stock price over rolling 3-year time periods fairly consistently. Now that's largely a factor of size and growth. However, if you look at the numeric data, where you standardize that information, normalize, and then rank companies on their water intensity, energy intensity, carbon footprints, and so forth, that is actually where we find alpha and ESG information for companies that are performing the best on those numeric data points, particularly where those metrics are material and relevant to the industry. So what we've done is we've kind of used this as the basis for the foundation of our framework, where we say we want to emphasize performance over just disclosure. And we do caution a lot of our investors that if you're using an ESG score that emphasizes disclosure, you run the risk of building a portfolio that is very large cap, slower going, lower returns, and more Western European. And so now I think what the message is for corporates is that be careful of what you are disclosing. You know, ideally, if you can disclose as many hard metrics as possible, that is the best outcome, because that is what increasingly investors are looking to go for. And just the simple policy statements are no longer going to be good enough. And you know, ideally, when you can disclose the numeric data, if you can set targets, that is what investors are looking for. You know, I don't know how much more time I have. Let me know if I'm running over. But you know, one of the things that we do have is our framework that is available to our clients. We've also engaged with some companies around this where they have good data. We look at 52 different sectors where we've selected the metrics that we think are most material, measurable, and then where there's data available, and we get to a framework that looks at 33 metrics on average in total, and that compares to the 100+ metrics that oftentimes we find a lot of these third-party raters are looking into. And there's been a lot of discussion from corporates around when they look at these headline ratings, they increasingly become uncomfortable with how they're rating the company. They're using stale data. So really what that means is companies need to have their own say in the matter, because if you are not reporting this information, somebody else will tell your story for you. And so that's becoming increasingly important to make sure that the data is accurate, it's timely reported. Ideally, if it's in a consistent framework like TCFD and SASB, even better. You know, with that, I'll skip through our slides on our framework and jump to something related to the taxonomy. This is where I'll end it. But for those not familiar, the taxonomy is something in Europe that is looking to create the definition of what it means to be green for effectively all economic activities at some point. It's mostly focused right now on environmental objectives, so there's no social taxonomy, but even within that environmental component, we're really only focused on carbon at the moment, specifically related to climate change mitigation and adaptation. We will eventually have standards for each economic activity related to water, to waste in the circular economy, pollution prevention and control, and then healthy ecosystems. But right now what they've done is they've set the definition of what it means to be green for 72 activities in climate change mitigation. For example, if you're a cement manufacturer and you produce cement below a certain carbon threshold per tons of production, you can claim that you are meeting the technical criteria. And that's really one of the biggest quantitative thresholds to meet. There's additional do no significant harm criteria that is set out there that's very qualitative in nature, and then minimum social safeguards. But what this is looking to do is put pressure on both corporates and investors. Investors that are factoring in ESG considerations into their financial products will have to comply with the taxonomy. And that goes for all financial products sold into Europe, as well as any financial products created within Europe. And so what they will have to do is report the proportion of their fund that is quote unquote taxonomy aligned. Now, one of the challenges with this that we see is what this will likely lead to is what we would call label chasing, where if you're an ESG fund and you're trying to market yourself as green, you will likely try to achieve the highest level of taxonomy alignment possible. Now, that will then put a lot of pressure on those companies that are fully aligned. There will be a lot of kind of crowding, we believe, into those names, as well as for companies that potentially are not aligned or fall outside of the taxonomy may be at risk from missing out on some of this flow that is likely to happen. Now, there's a lot of recognition that the taxonomy is not perfect, that it does not cover all sectors. We only find that if you look at the global investable universe, 41% of companies have some form of their revenue that is exposed to the taxonomy. So that clearly is a challenge for applying the taxonomy in a global diversified portfolio. But for the companies that do fit in, which fit into a lot of heavier sectors at the moment, utilities, real estate, materials, and industrials companies, there is an opportunity to looking into the taxonomy and marketing yourself as aligned. Because investors will have to comply with this by the end of 2021. Corporates in Europe, falling under the non-financial reporting directive, will have to start disclosing their alignment by 2022 off of their fiscal year 2021 disclosure. And so, you may start to see some of this shifting outside of Europe into other regions, like Turkey and like Asia, like the US, where if companies are kind of cleanly fitting in, they could benefit because there's likely going to be a scarcity value for companies that satisfy this criteria. And with that, I will leave it there. We've also done, and lastly, there's one last thing just to highlight. We've done a lot of work around looking at management incentives, looking at the differences between SASB, TCFD, but also management incentives, collecting kind of how companies or how CEOs are incentivized in the long-term, short-term pay plans. We're finding that ESG is cropping up more and more in those plans, unsurprisingly more so in Europe than in the US, but it is still growing quite rapidly. And I think it's a powerful tool that we've seen that companies are using to demonstrate that they're genuinely engaging on ESG topics and they care about achieving the targets and outcomes that they're setting. And so with that, I will stop there, but happy to take questions at the end.
Great, thank you, Evan. So you have Bertie White here. I sit on a slightly different part of Goldman Sachs from Evan, so I'm on the investment banking side. And one of my responsibilities is not only looking after the equity capital markets franchise, particularly focused on energy, but also as part of our efforts to educate our clients and engage with investors around sustainability. We form what we call the Sustainable Solutions Council within investment banking, and that means that within Europe, I spend a lot of time talking to both corporates at the boardroom level and investors to understand what's top of mind for them. I did have some slides prepared. I'm not sure whether the invigilator could put them up. If not, fear not, I can walk through them. There are really 7 points I really want to address today for you. And this is with a practitioner's head on. So, as advising you as people who work in companies, particularly in the investor relations side, what should you be thinking about as some of the key issues coming up and how the companies within Europe are beginning to address those. The first one, and this links, as you would expect, to Evan's conversation, is around data. And the whole of this journey starts and ends with the data that you as a corporate can produce. And how that data gets consumed is changing. So even a couple of years ago, that data got produced, it went to the ESG raters. They then applied their own algorithms and weightings to the various different elements that were provided by the companies. And that was then consumed by investors, and investors saw this as a score, and they treated it somewhat like sell-side research. In other words, they would take it as a good indication of a company's score and positioning. We have moved on slightly since then. There has been a growing sophistication at the large asset owners, and it is the large, not just the largest, where they increasingly have their own algorithms they apply, so they consume the data directly. They don't necessarily consume it direct from the ESG raters, but then they apply their own factors to that and come up with a view. But ultimately, it is still the data you produce, which is the starting point and the ending point for how you're perceived. So it's incredibly important to make sure that that data is collected with the right level of fidelity and on the right frameworks. And Evan mentioned a couple of the frameworks before. I've spoken to companies in the past where they were getting over 100 different requests with different frameworks and guidelines and forms to fill in each year, which is just unmanageable, particularly as you don't know where it necessarily goes. There has been a growing confluence on two key frameworks from a shareholder perspective, and those are the SASB, which Evan was mentioning, and also TCFD from a stakeholder, so a slightly broader perspective. That's CDP and GRI. And that's where the encouragement is coming from the BlackRocks, the AXAs, the Vanguards, the State Streets to focus disclosure on. But a very important element of that is the quality of the data and the trust that investors can put in it. Increasingly, this is financial, non-financial, I should say, information which is going into valuation. So investors are having their view on buying and selling influenced by the data you produce, which is outside of your audited P&L, your audited balance sheets as well. And that means there's risk for you as a company about making sure that data is properly compiled. Increasingly, what we're seeing in Europe is assurance, which is a form of verification being applied to the non-financial data. Most companies who do assurance within the UK, about 95%, give something called limited assurance, which is essentially a negative pledge. A number of them are increasingly moving towards reasonable assurance, which is more akin to an audit. This is typically done by the big four accounting firms, though there are independents who can do that as well. But this is an area where we are spending time with our clients, just making them understand the importance of the information they put out and making sure that they particularly if they're raising capital, can have confidence that data is being properly compiled. The second point I wanted to talk about was the raters, and we've mentioned these a couple of times. The key ones are MSCI, Sustainalytics, S&P, which recently acquired Rebecca Sam, ISS, the JO Iris. I mean, there are a whole plethora of these firms who, like it or not, if you are a listed company and you fall within their universe, they will be writing notes on you, and they'll be taking the data that they can find, and that data can come from your own website, from your sustainability report, or they could screen it from their own algorithms going through your website. And they will apply their own factors to that, and they'll weight them differently. What does this mean? It means there are, if you're a listed company, views out there on your ESG scores already, like it or not. There may not be good correlation between the two. That's because the different factors that apply to them. But there are three key things you should really have in mind. One is know your score. So understand how you're rated and why you're rated that way. That means you'll know where you're weaker versus your peers, where you're stronger versus your peers, and give you an opportunity to understand what the gap is. Secondly, is engage with these raters. You can have conversations with them. They're not perfect in as much that not all the information they pick up will be the right information in your view that should be used to analyze your company. So I very much encourage all companies to treat ESG raters as you would a sell-side analyst. So call them up, have a relationship, discuss what's important to you, the key drivers for your business, and then have a conversation. And particularly when notes are produced, and they tend to be produced on an annual basis, go through them very carefully, make sure the right information is being produced and replicated, because if it's not, then the wrong impression of you will be given out to the wider market and will be consumed. And then finally, it's actually use these scores for your benefit. So look to improve. What I mean by that is go through, as I say, know your score, but then understand your areas of weakness and the elements you can do to improve it. There may well be some elements which are simply beyond your control to improve. They might be industry specific. But I'm sure that when you go through it, and we've experienced this a number of times with our own clients, there are small things you can do to improve. And they may be disclosures, it may be making sure that your policies on a certain area are freely available. But I encourage you as a group to spend time and focus on this, because it is important. The third point I wanted to talk about, it comes down to your targets that you set, the ambitions you set, and also the incentives you set your management teams. And over the last couple of years, there has been a growing focus from corporates and investors on the decarbonisation targets that companies are publishing. Historically, Paris alignment was seen to be the gold standard. Increasingly, companies are moving beyond that. To give you just 4 examples, BP the other day So they're going to get to net zero by 2050 or sooner. Danone, the consumer products company, they're aiming for carbon neutrality by 2050, halving of their scope 1, 2, and 3 emissions by 2030. Microsoft in the US are going for carbon negative by 2030, and by 2050 they want to remove all the carbon they've emitted since they were founded in 1975. And then Apple, finally, they're going 100% carbon neutral by 2030. So you've got these big statements coming out, and they are seen to be important to investors. And therefore, within your own constraints, it's important to reflect on what are your ambitions and how should you scale them. It's not necessary to have a big ambition, it's necessary to have a credible ambition. And there is a big difference between the two. What investors really want to understand is the palpable actions you can take as a company to reduce your own footprint, how you will measure that footprint, so the time period over which you will be extending that. 2050 targets are great, but they are 4, 5, 6 more CEOs away, certainly probably 10 fund managers away from being achieved. So having a nearer term objective is much more powerful than having only a 2050 target. And more capital is being focused on this. So if I look at Climate Action 100 Plus, they've now got members who account for $47 trillion of AUM. The Net Zero Asset Owner Alliance is over $2 trillion. PACTA, which is the Paris Alignment's Capital Transition Assessment, that's nudging north of 60 trillion. So there's serious capital behind this and focus on this. And the other way to credentialize yourself and really prove that the targets have real impact within the organization, the execs are focused on it, is through 2 measures. Firstly, it's ensuring that at the board level, there is ownership of this dialogue. And so there's a board member or 2 who are on and chair a sustainability committee and have board level oversight. That's really important to show that it's been taken incredibly seriously. The second, as Eva mentioned, is around incentives and making sure that the executives are incentivized to deliver this. And increasingly, we are seeing ESG as a factor be included in incentive packages. What we've seen is them accounting for anywhere north of 10% of the total LTIP, sometimes up to 50%. We've seen in very, very rare examples of the LTIP being included as part of an ESG metric. What this really does is show that the execs themselves are focused on it. Now, this isn't without controversy. There have been a few observers who pointed out that this should be ordinary course for the execs, and this shouldn't be part of a bonus. But nonetheless, the current weight of opinion is that it is an important factor and one that should be included in incentives. So that probably brings us on to the slightly more interesting area for this audience of communication. So how should you communicate your ESG ambitions? How should you engage with the market on it? 5 things I really want to focus on. Firstly, it has to be seamless for strategy.
Yeah, I could probably take over a little bit of kind of what we are seeing. It might not be the five bullet points that Barry will lay out, but if he comes back, he can cover it. I mean, I think one thing we're noticing in general when we talk to corporates that we find that is helpful the most is just simply being clear. One of the things that I think the expressions I've used is clear is the new clever in a way when it comes to ESG and discussing your strategy. I think there's 2 camps right now to kind of ESG right now, where a lot of times if the data does not exist, there's simply the worst outcome that is viewed and the worst score is attached to that company. So saying something is better than nothing. And even if that data or disclosure that you are reporting on may not be the best in class, I think there is actually an appreciation for that from the investor community, that they recognize it's a journey for the company. And as an example here, if we look at water usage as a metric, we have water usage in our framework to measure companies on their water intensity, but we then also get some amount of disclosure, but less around how much of that water is recycled. but we get very, very little data related to I see Bertie just joined back. I'll finish my one thought. We get very little data around the percentage of water that is sourced from water-stressed regions. And some of these more contextual metrics are very, very helpful to helping an investor understand how well you're taking care of a particular ESG issue. So that is where TCFD, SASB, I think, are quite helpful. They get quite deep in what they ask companies to report on that gives context. But Bertie, you're back.
Yeah, and apologies for the link dropping. I think where I got to was communication and talking about this being probably the most interesting element for this audience around how best we see companies communicating, what the key principles I have in mind are. So kind of the first point I was making was it's got to be seamless for strategy. So investors can tell immediately if your sustainability strategy is going one direction, your corporate and financial strategy is going another. So ultimately, it has to be the same. What it's about equally is risk avoidance. So is making sure that investors understand that as you are running the business, you're avoiding some of the pitfalls which are coming potentially in 5, 10, 15 years' time, whether they be a carbon tax, whether they be the right balance of employees, so your neurodiversity is impaired, or having poor governance, which could lead to fines and sanctions. It's about risk avoidance. But at the same time, and this is where the EU taxonomy is really heading towards, it's all about opportunity capture. So is your business being positioned to capture some of the main trends that are going to impact your earnings potential over future years? So your own customers will be focused on decarbonising. Are you doing the most to pivot your products to capture that trend? Are you exposed to one of the secular growth areas of the economy, whether it be renewables, whether it be lightweighting through aluminium, whether it be through non-traditional foodstuffs? There are plenty of different sources, but it's highlighting the opportunity that you see as a company that comes from that. And if you put those two bits together, the risk avoidance and the opportunity capture, this really simply comes down to the investment case of the company. It's more complicated than that. All we're doing is we're extending the length over which you normally project forward about the opportunity and the risk beyond the traditional horizon. The traditional horizon might be 1, 2, 3. We're just saying push it further, because when you push it further, you have that prism of how am I running the company to protect value, and how am I running the company to capture value. Then that's all the fund manager really wants to hear. But it has to be credible, and this is a point to get. Anything you communicate around. Oh, I had some interference there. I'll keep going. Anything you communicate needs to be credible. And what we mean by credible is both in your targets and then how you apply this. Almost what works worse is having an investor presentation and suddenly one big green slide is stuck in there, which seems to be forced in and out of context. Because it just seems to be a bit of a greenwashing, a bit of a sock trick. Equally, if you are looking at the UN sustainability goals, focus on the ones which matter. Don't claim to have alignment with all 17 of them, because that simply doesn't add to your credibility. What we're seeing the really good companies do in Europe right now is integrated reporting. So when you talk about your annual report, you're compiling that alongside your sustainability report. So it's a very seamless production. That goes with that point I was making earlier around strategy. It's making sure that the data you produce is incredibly easy to be accessed on the website. So they're just downloads. So as and when the raters, which they will do, come and look at the data, they can find it very quickly. It's engaging on the topics with investors in a regular and a direct manner. By that I mean including a regular slide in your presentations around ESG. So always have it there top of mind, but do it in a way which is appropriate to your company and appropriate to your strategy. But then once a year, have a roundtable with investors and the governance heads of the institutions and bring out the board so that you can really see it coming through. The fifth point of my 7 that I was going to talk about was on the financing side. And this is another area where companies have looked to credentialize their movements within the green ambitions, but also raise capital. And the green bond market, as you might have seen, it has grown incredibly rapidly. So in 2015, there was about 43.5 billion of issuance of bonds. Last year, there was 290. This year, so far, there's been 260. So there's been a huge increase in the access of green financings. This started off as pretty much uniquely green bond financing, which is financing raised for a specific project. Now that has changed quite a lot this year alone, with social bonds, sustainability bonds, transition bonds, sustainability-linked bonds, which allow companies to raise capital for means outside of a single project. So it could be for a broader decarbonisation project, for instance. In addition, what we have witnessed is a huge amount of interest in these products from investors. And one of the metrics we track is the pricing differential between a green bond and a traditional bond of a similar maturity. And in the last couple of months, there have been a number of issues where there's been a notable premium that the green bond benefits from, or we call it a greenium. So if you look at Daimler in their recent bond issue, there was a 25 bips greenium. Volkswagen had a 10 bips greenium. Suzano on a sustainability-linked bond had a 5 bips greenium. So there is real pricing benefit that's coming through from accessing these green bond markets. The penultimate topic I just wanted to impress on you was how this is now impacting the strategic thinking of companies. I mentioned at the start that I spend a degree of my time in the boardrooms of some of the largest companies in Europe. And the topic continually arises as to how should I be looking at my asset perimeter as a company? How should I be looking at the scores that I'm having at my Paris alignment? And what should I be doing to my portfolio in order to benefit most from this green trend? And this is driving already conversations, acquisitions, disposals, as companies look to pivot. Now, very simply, this could be a utility who has a relatively small amount of coal-fired generation, but over a threshold limit for investors. And by retiring early or selling some assets, they can then not only remove a potential liability, but then increase the ability of investors to hold them. But also it's about pivoting businesses, and you would have seen this very clearly with the oil majors, both Shell, Total, BP, as they're pivoting their business away from hydrocarbons and towards electrons in order to take advantage of the energy transition. The other area which is of increasing focus for boardrooms is around activism. As I'm sure this audience knows well, I mean, activism as a theme has grown enormously in the last 5 years. It's spread its wings outside of the US and is very much within Europe. If you go back through time, how do activists best work? They best work by getting as many of the investors to support their proposal as they can. Historically, that meant going to the index funds, where there's a large weighting of index ownership, both in the US and in Europe, and convincing them that the merits of their proposal, particularly on the governance side, were merit-worthy for support. Guess what they're doing now? They're looking at ESG, so recognize that the index funds themselves are very ESG focused. So if they could add another string to their attack, which is perhaps more ESG focused, then that can put pressure on companies. And there have been a handful of funds who have publicly stated already that this is a theme they're focused on. So you've got TCI, Chris Hone, and then you got Jeff Ubben, who was the founder of Value Act, and he started Spring Fund, and then he's moved on from Spring Fund to a new vehicle called Inclusive Capital Partners, where he's said that this is his main edge is going to be using ESG and sustainability within that as a route to get investment and then create change at companies. The final point I want to mention has a degree of overlap with Evan's, which is around the taxonomy. And Evan spends a ton of time talking to investors on this topic. Time to corporate on the topic. I'd say that corporates are a little bit behind investors on this at the moment. They are beginning to learn about it. This is going to be potentially a very large impact on fund flows and how companies present themselves. And whilst there's confidence that there will be AUM flowing into those those funds who are taxonomy aligned, the ability for companies to actually report and prove that they are aligned is quite challenging from our perspective. So we have the sectors which Evan went through. The two other filters are quite tough, though. The do no significant harm is perhaps the easier one. But when most of our clients are beginning to struggle when they look at it is the minimum social safeguards, because it's compliance with the UNGP, the ILO Convention, the OECD guidelines, the International Bill of Human Rights, and it's for the company, and these are cumulatives, for the company as well as the supply chain and other key business relationships, which is a pretty high hurdle. But for those who can prove that they are aligned, they do have aligned activities, there will be potentially a great reward in the sense that there won't be many of you, and the ability for investors to hold you will therefore be a premium. Those are my top 7 topics from an advisory perspective I wanted to pass on. And again, apologies that the line dropped out for a while there.
Another thought-provoking discussion by our guests, Bertie and Evan. Thank you very, very much.